Most investors focus only on returns and ignore the structure that keeps wealth intact during uncertainty. Markets rise and fall unexpectedly, and even strong assets can fail at the wrong time. Diversification exists to protect investors when prediction fails and conditions change. It is not about spreading money randomly, but about building a system that survives shocks and continues working quietly in the background. In this video, you will understand why diversification protects investors and why it remains essential for long-term wealth. Like and subscribe to continue learning strategies built for stability and endurance. 1. Diversification as structural defense. Diversification functions as a structural defense rather than a performance tool. It accepts that uncertainty cannot be eliminated and designs around it. Instead of relying on one outcome, diversification spreads exposure across different behaviors. When one investment weakens, another may remain stable or improve. This prevents single points of failure. Diversification does not guarantee profit, but it reduces vulnerability. Investors who rely on concentration assume accuracy. 2. Why concentration increases fragility. Concentration creates fragility by tying outcomes to a narrow set of assumptions. When those assumptions break, losses accelerate quickly. Even strong investments can suffer from timing policy changes or external shocks. Concentrated portfolios amplify both gains and losses, but losses matter more because recovery becomes difficult. Diversification reduces fragility by limiting dependency. It ensures that no single failure determines the entire outcome. Fragility is invisible during good times, but devastating during downturns. 3. Different economic responses. Assets respond differently to economic conditions. Some benefit from growth, while others perform better during slowdowns. Inflation, interest rates, and global events influence assets unevenly. Diversification takes advantage of these differences. Instead of betting on one scenario, it prepares for multiple possibilities. This creates balance across cycles. Investors do not need to predict which environment will dominate. They simply remain positioned. Over time, this balance reduces volatility and smooths returns. 4. Psychological stability through diversification. Investor behavior often causes more damage than markets themselves. Fear, panic, and overconfidence lead to poor decisions. Diversification reduces emotional extremes by smoothing portfolio movement. Smaller swings reduce stress and impulse. Investors are less likely to abandon plans during downturns. Emotional stability improves discipline. Discipline improves outcomes. Diversification indirectly protects returns by protecting behavior. 5. Survival enables compounding. Compounding requires time, uninterrupted participation, and capital preservation. Large losses interrupt compounding by reducing the base. Diversification protects capital by limiting downside exposure. Investors who lose less need smaller gains to recover. This advantage compounds over time. Survival through downturns ensures continued participation. Diversification favors endurance over extremes. Long-term wealth is built by those who remain invested, not those who chase peaks. 6. Managing uncertainty, not eliminating it. Uncertainty cannot be removed from investing. Economic systems evolve unpredictably. Diversification accepts this reality and manages it. Instead of reacting to each change, diversified portfolios absorb impact gradually. This reduces the need for constant adjustment. Investors gain confidence in the system rather than reacting emotionally. Diversification is proactive rather than reactive. It prepares for unknown outcomes without needing foresight. 7. Capital preservation as priority. Preserving capital is more important than maximizing returns. Large losses require disproportionate recovery. Diversification limits the size of losses. This preserves optionality and flexibility. Investors with preserved capital can adapt and reposition. Those with severe losses are forced into riskier behavior. Diversification prevents this spiral. Capital preservation supports strategic decision-making. It allows investors to remain patient rather than desperate. 8. Time-based diversification. Diversification is not only about assets, but also about time. Investing across different periods reduces reliance on timing. Markets fluctuate unpredictably in the short term, but stabilize over long horizons. Time diversification smooths entry points and outcomes. Regular participation spreads exposure across conditions. This reduces regret and improves consistency. Time becomes a stabilizing force. Diversification across time complements diversification across assets. 9. Limiting irreversible mistakes. The greatest investing risk is irreversible loss. Diversification limits the impact of mistakes. Investors do not need perfect decisions. They need survivable errors. Diversification ensures that being wrong does not end the journey. It transforms errors into lessons rather than failures. This margin of safety encourages rational behavior. Limiting irreversible mistakes is more important than chasing perfect outcomes. 10. Diversification as long-term architecture. Diversification is not an adjustment. It is architecture. It is designed at the foundation of the investment system. It supports uncertainty, discipline, and patience. It does not seek excitement. It seeks durability. Over decades, this durability compounds quietly. Investors who embrace diversification accept moderate variability in exchange for survival and growth. This architecture protects not just portfolios, but entire financial journeys. Diversification protects investors because it aligns with how the world actually works. Outcomes are uncertain, cycles repeat, and surprises are unavoidable. By spreading exposure, investors protect capital emotions and long-term plans. This protection allows time and compounding to operate without interruption. Diversification may not promise excitement, but it delivers durability. If you want to continue learning systems designed for long-term stability and intelligent wealth growth, then like and subscribe so you never miss insights built for endurance rather than speculation.